I'm Simon Wynn, and Paul here's Paul Thompson.
Yep.
We both, I think we both are on the same journey in residential real estate. I've been doing residential for 7 years in real estate, and then not too long ago have ventured into commercial, and that's where we're at. And I think Paul and I are in the same path. And that's how we got connected, was through other masterminds that we joined, and we kind of see the same eye to eye on a few things, and we just thought, hey, the best thing for us to do this and to learn is to bring on experienced guys and experts like Trevor on, and while we're learning, we feel like we can just share the knowledge with our audience, and so they can learn also as we learn. We never claim as to be as experts for sure, but we've been in real estate for a while, but we're always open to learn, and now we have we're just very fortunate to have a guest like Trevor on the call, who, man, just looking at his bio and what Trevor's done, 20 syndication deals, which they're passive deals that he's done, and I guess 6 of those have gone full cycle, meaning that it's already been exited, and then he's active, which is a GP on 3 of those. So very, very busy guy and experienced. So we're very happy to have Trevor on today, and so welcome, Trevor.
I'm excited to be here. Thanks for having me.
Awesome.
All right, everybody can chat now. So if you're out there, please find the chat box and say hello. We see that Dwayne is in from San Antonio, and this is a new concept to him. So we'll start at the fundamentals, and Trevor can fill in some of the gaps as we go. And we have John Bartlett from Coastal Bend. Yep, thanks for joining against John. And then Tarso is a buddy of mine. And make sure when you chat, make sure to chat to everyone if you'd like. Tarso, good to see you. He's been an investor in some other investment projects I've been involved in. And I've never had a chance to meet him face to face, but I'm looking forward to doing that someday soon. So let's dig into Trevor's experience. Trevor, so when we talk about this idea of doing syndications, and I think we have some relatively new investors on here. Let's just define very quickly what a syndication is, and then we'll go into your experience.
Yeah. So I actually like to make an analogy. So if you could imagine that you want to go on a journey, so you want to go on a trip, and so would you buy an airplane, get a pilot's license, and do all of those things? You wouldn't, right? You would find an experienced operator of aircraft, and then you would buy a ticket to go on your journey. So passive investing is very much like that, where you're not the person responsible for it. So you find people that you know, like, and trust, which is hugely important, and then you give your money to them, and they execute the business plan. And so that's in a nutshell what it is. And if you think about it, it's syndication takes a whole team, just like an airliner does, right? So the captain could be the lead syndicator, asset manager. They have their stewards and stewardesses that are taking care of the people that are on the flight. They have the mechanics that are taking care of the plane. That's our property management company. And you, as a passenger on the plane, you pay to go on the plane. And then once you're on the plane, you have no responsibilities, right? It's not like they pick up the intercom and say, okay, Trevor, it's time for you to fly the plane. It's your turn. They don't do it. And you arrive on your destination. So that's a real simple explanation of it, that you're investing in somebody else's deal. They're buying a real asset, and they're implementing a business plan. So it's a business that's running. And the goal of it is to buy an asset, improve its value, and then sell it for more. And while you're doing that, it produces cash flow, and best tax benefits of any investment. And then when it sells, that's when the larger payday is.
I really like that analogy. Yeah, I've never heard that before, but I really like that. Well, the reason I like it the most is it being an airplane is that you can't get off until the operator finishes.
Right.
That's why that lands so well. Huh. Because how many times have you been on an airplane? You're like, man, I'm just done with this. And there's delays and you're frustrated and you can complain all you want, but you have no control to get out.
Yeah.
Very
Yeah.
similar with the syndication. That's a really
It
good
is.
analogy.
Yeah. And of course, there's lots of different types of syndication. There's lots of different things. It's the sky is the limit, right? And I also, the way I like to do it, another analogy is that the most important person in the deal, think of them as the jockey. They're the person that's in charge, right? So the jockey is the person that's in charge. And then the horse is the asset class, and the track is the location, right? So again, the most important person is the person that you have the relationship with that's responsible for implementing the business plan. So you want to make sure that it's a good jockey. They know what they're doing. And then
And that would be
can,
referred to, I'm sorry, that would be referred to as the syndicator or the operator.
That's correct.
Okay.
Yeah. And it takes a team, right? So you may not know everybody on the team. Normally, you know one person on the team and they kind of vouch for the rest of the people on the team. And, and sometimes teams are fluid, so I'm in 3 deals as a GP and I have different team on each one. Now I've joined Massive. I'll be part of a different team over and over again. But, it's not always, but again, you want to find somebody that like, and trust. They're normally a person who's helped educate you, just like you guys are doing with what we're doing here tonight. It's very important that you understand about them first. And then, of course, there's lots of different, so some deals are shorter, some deals are longer, different assets classes perform different ways. I mean, there's a myriad of options out there. So as a passive investor, most of my syndications are multifamily. And multifamily, and the reason why I like multifamily is it serves a multiple purpose. First of all, America needs housing. They need good quality, affordable housing. And so we're normally buying properties and improving it for the tenants, obviously increasing the rents and producing a cash flow. So that suits a really big need of what you're going to provide. But I also have an investment in a retail strip center. Not the best timing. We closed March 15th, 2020, and we all know what happened. But it's been producing still some cash returns. The market's turning around and we'll be able to sell it quickly. I've got an investment in a medical center. I've got an investment in a new build storage unit. And then most of my investments are in Texas, but I also have investments in Tucson, Arizona, Columbia, South Carolina, Charlotte, North Carolina, and soon to be in the Georgia market.
Do you focus on that particular region, which you might consider the Sun Belt, Texas and the Sun Belt?
So I definitely, so the track is the last one, right? So the where is very important. And the where is, what's most important about the where is you want to make sure, first of all, that it's an area that is growing. Jobs are coming to it. People are moving to it. For those of you that are in Texas, we all know that people are coming here. I live in Austin, and 5 years ago, I used to drive by cows and fields, and now there's 30,000 apartments and a light rail station. One of the deals we just did is a land entitlement for building some townhomes in Georgetown, 30 minutes from my house. Huge development. I mean, there was nothing out there. So I look for pro-business states that people are moving to. So pro-business states mean that they like business. They don't put in laws. So, people do make money investing in California, but it's a tough world. You've got to understand, rent control, lots of other things that happen. So I've always looked for pro-business and growth states. And so right now, Arizona, Texas, North and South Carolina, Florida, and there are other growth areas. They're just not as big as that. Those are the really big areas of growth. And, anybody in Texas, every day there's a new announcement of some headquarter moving to Austin, Houston, Dallas. I mean, every day. One of my land deals is 10 acres right behind the Tesla factory. You know, and tell me the Tesla workers don't need places to live
Mhm.
because they were built in a fairly remote part of Austin.
Trevor, I love your analogies. Everything that every time you and you know we know each other, and every time you speak, you use these analogies that really connect the dots for me, and so I really appreciate that. You know, the airplane one, the jockey was really good. So speaking of the jockey, and being able to pick out the best jockey to who you work with, that's the person that's running the deal. We in real estate terms, we call it those, you know, the sponsor, the operator, or the general partner, the GP. So if you can share with our audience, what are some of the ways that you find best that you can share with our audience, that, you know, to pick the right jockey, you know, you know, what are some of the ways that you can share to help our
Yeah,
audience?
yeah. So, you know, it's very interesting because I'm actually a little bit, I like, you know, one of my best investment deals was with a group that actually, well, I went to their webinar and they talked about what went wrong. And, you know, they managed to save the investment, but it was a tough one. And, you know, for somebody to go on a call and be honest about their mistakes, right? You learn more from your mistakes than you ever do from your wins. So first of all, I like a sponsor that is honest, that tells you the truth. You know, we all look good. We were talking earlier about how much I post on social media. You know, I look good on social media, but at the end of the day, you want to know the person, right? You want to have a couple of conversations. You want to have lunch or dinner or go to a meetup. You want to be able to connect with this person and realize this is somebody that I relate to. Their values are similar to mine, right? You don't want to give your money to people that don't care about their tenants, don't care about the business, don't care about their investors. So you want to look for people. And I refer it to as very much like a marriage, right? So you're going to meet somebody and go, oh, you know, that's a good looking guy or girl, but let me figure out, let me get some time with them, right? Let me spend some time and see if they're compatible for me. Now, our marriages in real estate aren't for life. They're for, you know, 3 to 7 years, let's say, but you still want to make sure. So you want to get to know somebody, you know, and you want to make sure that they have a good track record, that what they're saying is reasonable and achievable. And you also, very important that you have people that know their market, right? So, you know, when you're doing a deal in Dallas, you don't want all the sponsors to be in New York City. You want somebody with boots on the ground, right? That can see the asset, that can respond to things, that can do things. So all of those things are very important. I tend personally to stay away from the big groups because I like that personal one-on-one relationship. Doesn't mean the big groups are bad and the little groups are good, you know, better. I just like to know people. You know, I like to be able to text my sponsor and get an answer. You know, and I work really hard not to be Monday morning quarterback and question everything, but you know, I like to do that. But it's a relationship business, right? And then it takes a team. So you may only know 1 or 2 people, and you've got to assume that those people are associating with good partners, right? You know, that they've done their due diligence on who they're doing a deal with. And, you know, so you vet the people first, then you vet the deal second.
100% agree. I feel in my mind that the sponsor, if you pick the right sponsor, that's 80 to 90% of your battle. So the deal is good, but you know, if the sponsor is really good, they won't put themselves in a situation where they're getting in a deal that is lousy. So you know, to me, I think you won most of the battle if you pick the right sponsor. So thanks for sharing that, Trevor. That's great. That's what our audience need. So you know, back to like the sponsors and the deals and stuff, but what are some of the ways that you do to avoid the bad, you know, at least in the best of your ability? You know, what are some ways you done
Yeah.
to vet?
You know, again, you got to be a little bit secret, you know, sneaky. So I find people that have invested And then I say, is there anybody in the investment group that complains all the time or always asks questions or is extra demanding? Because I want to ask those people what, why? And again, it's like, hey, who knows this girl or this guy? Are they nice people? Who do they know? Who are their friends? Who's their brothers? You want to try to find out who's in their network. And you also, again, like I mentioned before, you want to associate, you want to invest with people that you get a sense with talking to them that they care about their investors, right? That they want to do a good job. Also that they're doing this for a living, right? So some people do have a W-2 and they raise money, they're not, but somebody on the team needs to be full-time. This is what they do for a living. And then I also look a lot at the deal. How are the payments happen, right? So I like deals that have a preferred payment. What a preferred payment means is, as an investor, I get paid first. So let's say a lot of deals, you get the first 7% of cash proceeds. Okay, they go to the investors. Then I don't mind if the deal has what's called a waterfall. So get a little bit more complicated, which means if the deal is super successful, the general partners can make more money because that's a win-win, right? So I get paid first. I get basically, I'm going to first 7%, let's use it at that. And then I'm going to get a 17% IRR, internal rate of return. That's kind of the gospel of what you want to look for your return. And if it's greater than that, the split can change. And I'm okay with that because on most deals that have a 7% preferred, general partners aren't making money for the first 3 years at all. They're just working, they're doing their things. Yeah, they made some money in the acquisition, they're making a little money, but their real money doesn't come until the investors make money. So I look for deals that are structured that way. I like those. Not all deals are structured that way, but I like those. I also try to balance out my investments. So I look at it as if I'm playing baseball, okay? If you go for a home run on every time, you're going to strike out a lot, right? So what I do is I mentioned the medical center. It is a straight 10% pref, no upside. But to me, that's a single. And you got to remember on medical center, there's this thing called triple net lease. This is the granddaddy of triple net lease. So not only does the doctor's practice guarantee the lease, he has to personally guarantee the lease. So he's going to lose his Porsche or his house or his whatever. He's making sure the rent's paid or somebody else is in the space. So I'm okay. I look at that as a single. It's gonna give me every quarter, boom, I get an email, the money goes into that's through my retirement account. Then there's a couple of deals that are doubles, right? So they're property, but they're not big, deep value add. They're consistent, so the new build storage I'm looking at is a bit of a double, right? I'm hoping it's a home run, but for sure it's a double, right? We're building something, it's going to come along and, and it's got different cash flow. That has no cash flow for quite a while because they have to build it. It's a new build. And so you have to look at doing all of the different things. So, to make sure you do that. And then every once in a while, you got to invest in a home run, So I did an investment in a home run. My best investment to date was that group that I told you I spent a year going to their webinars. I passed on 2 investments. I invested in the third, and they tripled my money in 20 months. Home run, baby. That's a home run. Yeah. And boy, they had a deal going. And that money showed in my bank account at 1 o'clock and was gone at 3 o'clock. I already filled out the paperwork to put my money back in because they had a proven track record with me. Now, yes, I looked at the deal and I did, but not near as closely as it took me a while to go in the first deal. So again, and that was very fortunate timing, right? So that's when markets were super hot and there was a lot of growth and there was a lot of rent growth. The world has gotten a little funky right now, right? So we're not getting the rent growth and we're in a high inflation and a high interest period. So again, if a deal works today, when the world normalizes, it's even going to look better.
So I have a question. You threw out some terms like preferred return, and you said it's very common for multifamily for that to be a 7-8 range. And then you talked about this other deal that gave you a 3 times return in let's see, 20 months.
Yeah.
And from my experience, that's on the continuum of investments. That's one of the better returns you're going to
Yeah.
get. Let's talk about the range of potential returns, and when you're putting out the $50,000-$100,000 investment, what risk are you taking on, and how are you thinking through those
So
different
So every
investments?
deal has risks. So I want to make sure that you understand it. And this is an investment. There are risks. Out of 20 syndications, I have had one total loss. It just actually happened last month. And it was not enough insurance, which is something I never thought I'd have to worry about. So that was very unfortunate. Everything else has performed pretty well as planned or slightly better than planned. So again, you're normally looking at a deal, and again, it depends what type of deal and what the structure is. But on most, a lot of us are investing in value add multifamily. So there's very little cash flow for the first 9 months because you're turning the property around. Then there's a little bit of cash flow, and it kind of builds through the deal. And then if the cash flow gets good enough, they might do a refinance or add a supplemental loan. And there's some possibilities, but let's not make it too confusing. And then normal deal is 5 years. That's kind of what it is. And I always asked a lot of questions at the beginning. Why 5 years? Why 5 years? And it was the highest impact of time for money. So IRR is your internal rate of return. It's the return on your money. So on a normal real estate deal, you want to double your money in 5 years on average. Okay. And that basically gets you around a 17% IRR, internal rate of return. So if you double my money and it takes 10 years, I'm not near as excited, right? Now everybody thinks, well, you doubled your money still. No, it's time use of money. Because when you double my money, give it back to me, I can invest it again. And let's look at the math of doing this. So I started when I was old. So anybody here that's not old, make sure you start early. Okay, so put $100,000 in a deal and double it in 5 years. It's 200,000. Reinvest all of it into a deal. 5 years later, it's 400,000. Reinvest it into a deal. 5 years later, it's $800,000. 5 years later, invested in another deal. It's $1.6 million. 5 years later, invested in another deal. It's $3.2 million. Just think of that. So all I did was I doubled my money every 5 years, which is what we hope to get on normal. I reinvested everything. I took nothing out for myself. And just think of that. So, if you're 25, 30 years old and it takes you 30 years to get there, just think of that. If that's the only thing you did, that's pretty impressive, right?
With only $100,000 to begin with.
That's correct. So the power of real estate, right? 90% of all people that are millionaires became so through real estate. Now think of this, with all of the depreciation and all of the things we get, in theory, it's almost tax-free. So think about that. What else is tax-free? And at worst case, it's capital gains tax. And just think of those things. It's an amazing system. And then of course, I don't want to get too complicated because there's all kinds of other things, right? Like mostly you can't come out of a syndication and do a 1031, but other investment deals you can. And, there's lots of things. So, love them or hate them, right? Donald Trump said, I pay no taxes. So, why? Because he's a real estate investor. Yeah. One other tip that nobody knows, you know why he buys golf courses? Hmm. So if you donate a portion of the land to wetland preservation, you get a 10 times tax benefit. So think of that. If you paid $1 million an acre, you get a $10 million tax write-off because you donate. And who can golf in the wetlands? Very, very interesting, right? So real estate, they have all of these loopholes that make the rich get richer and things. And then if you move it along, and then, so this, everybody says, oh, what's my master plan? My master plan is to eventually grow into lots of units, 1031 into ones where I'm a substantial partner. Then I'm going to die, and my kids are going to inherit it at a stepped up value with no tax done. So think of this, I could take $1 million, turn it into 5, buy something that's now worth 10, die, and I've paid no tax. And my kids inherited tax-free.
Tax-free.
Pretty crazy, right? Now they'll pay tax as it grows, but pretty crazy when you think, where else in the world can you do that? other than through real estate.
What I'm hearing is, let me ask you the question to dig deep into this. So if I go out and buy let's make it easy, $1 million or no, $100,000 piece of land, and that is near somewhere that is you can donate as wetland. That means I can write off $1 million.
We have to do it in the right area on the right land where those incentives happen. So they're very big in Florida because Florida has a water problem. If you don't know, Florida spends all of its energy on water retention because it's actually fresh water floating on salt water. And if the two ever mix, Florida now becomes the ocean. So Florida has but and again, it's not normal, right? Because it's portions thereof. So you can't just buy an acre of woodlands and then donate the acre of woodlands. It's portions of larger real estate deals. It's a complicated real estate transaction that only a few can do it. There are other really crazy ones like opportunity zones and lots of other things that the government. So all I'm trying to say is that the government puts all of these things in to incentivize us to own real estate, which is what we're talking about. And so when you think about it, it's like, it's amazing, right? So you have an investment that's successful on its own, but because of all the different things with depreciation and all the different tax benefits and things, it's the creme de la creme of taxes.
Okay, so
I know I probably went a little deep. Sorry.
No, it didn't at all. We were just commenting on the or checking the comments here. So I want to put everybody in their shoes, or I want to put you in the shoes of some of these investors who have maybe done one or two investors, but are they're curious about syndications and they maybe have some capital to deploy. Who is the type of person that you see being a good LP in your experience? I think you started as an LP at first, and then you've then gone on to be a sponsor with some of these. Yeah.
I mean, so being an LP is really easy. You just have to have money. So it's pretty easy. So I got lucky. Our work got bought out. I got a payday. And so I had some money I could spend on it. By the way, I got killed in taxes on that payday. And let's talk about one other thing too, the power of passive investing. Warren Buffett said, until you can earn money in your sleep, you will work till you die. Well, how do you earn money in your sleep? You have to put your money to work, not you to work, right?
Yep.
So I spent a large portion of my life trading time for money. Tremendous amount of portion of my life trading time for money. And if I was smart, like the thing I said earlier, if you could imagine at age 30, when I got a bonus, and if I'd invested it in real estate instead of bought a new car or upgraded my house or did whatever I did, I'd be in a totally different situation now. So again, so starting out, but the most important thing is you need to start educating yourself. So I believe everybody who's showing up here is interested in educating themselves. And so, connect with Simon and Paul or myself. I do post a lot of educational material on my YouTube channel that I try to do. And, my goal is not to take your money. My goal is to create financial independence for you, right? I want to give you the vehicles. I want to give you the opportunity to access to be able to do that. And at the end of the day, I have a goal of 1,000 people to be financially free. Doesn't mean 1,000 people gave me money. It means 1,000 people, something I said resonated with them and it pushed them over the edge. Okay. I was terrified for years. I didn't do the thing. I wasn't brave enough like you guys to do the single family stuff. I was afraid of toilets and tennis trash. I was terrified. Then I kind of got over it and I started understanding it. And I went to no time, no money, because I was trading time for my money. And then all of a sudden I went, wait a minute, I just got this big payday event. I got killed on income tax. You stupid idiot, for 20, 30 years, you've heard about this. I actually, and I said, the year won't end before you get involved in real estate investing. And I started going to seminars in October. I went to like 5 different ones, finally found a group that I resonated with, liked. Felt I could invest with people I knew and I met at the meetings, and I made 2 investments by the end of the year, and that was.
And what year was that? Trevor?
That was in 17.
2017. So 6 years ago.
Yeah.
Wow.
Is it that many? I'm getting older.
So 6 years ago, you were able to get some capital from the exit of your company that you were part of, and you got killed in taxes because that was ordinary income.
Yeah.
And you had this wake up call. It's like, oh my gosh, I've got to put this stuff to work and start have my money work for me versus me always working for myself, exchanging time for money. And you'd heard about real estate all along. Sounds like you were at least curious about it before that.
Even with work, I did some dabbling in it. I had some friends that did very well in real estate. And to be honest, I really wanted to do the single family thing, but I got ripped off fixing my house, and I thought, why do I want to make this a job? I was totally fascinated with Airbnb just because I was in the entertainment, customer facing business. So I thought I'd be good at it. And in fact, hotels was something that I looked at very seriously. And I still haven't made a hotel investment because they got killed in COVID, and I'm just sort of waiting for the world to normalize a little bit. But I definitely will make, and there's another space we never talked about because soon I'm going to be in one, senior assisted living. So that's a big space, right? We're all getting older. And that's going to be a big space too for people to get into.
The silver tsunami that's washing over us, right?
It's coming, and I'm one of them,
Yeah. Okay, so let's talk about maybe where this current day. It's 2023 as we're recording this, and some of these people are curious about syndications. What is going on in the marketplace? What's the market dynamics? And where do you see, like, pull out your crystal ball and wax profound and prophetic about what's happening in the next few years?
Yeah, so definitely up until, let's say, 6-9 months ago, we were in, like, anybody could make money in real estate almost. It was pretty easy.
Right.
Because, prices were going up, rents were going up. If you were investing in smart area, it was easier to do it.
Yep.
And then, clearly the tide went out, and I'm going to quote Warren Buffett again, nobody knows you're swimming naked till the tide goes out. And we all know there's a couple of deals a couple of weeks ago, the tide went out, they were swimming naked, and it's not good. And so again, those people had produced good deals, but also there were some warning signs that maybe if you were doing the due diligence, right, they actually got kicked out of one of their mentorship programs. When you get kicked out of a mentorship program, it's a pretty big red flag that you weren't following some of their rules and different things. And that's not doesn't mean if you're in a mentoring program, you're never going to make a mistake. So I want to make sure I'm clear. So operations now is more important than ever. Cash reserves are more important than ever. So a lot of deals, they just raised enough money, kind of get closed, and they were making money hand over fist, and it was kind of easy. And then all of a sudden now they've got to make more interest payments and some other things. So you want to make sure that the deal has some reserves. You want to make sure that the sponsors have skin in the game. So it got, again, when everybody was making good money, sponsors stopped putting their own money in deals. So I mentioned, investors get paid first, all the other things, but it was another question I missed really is how much are you investing in the deal, right? And you do make money on an acquisition fee, but at the end of the day, you want your sponsorship team to have skin in the game, right? You want to make sure that their money is aligned with yours. And that's another very important question. And again, the who just became more and more important, right? And it still doesn't mean something might not happen. But people that are very resilient, very trustworthy, they work hard to make a deal work.
Yeah, I got a question that I have to ask you here. So, going back to all your experiences and things like that, and if you had to do it all over again, what would you do differently?
Yeah, so I would have started earlier, as I've already mentioned a million times tonight, right? I would have started earlier, and I might have switched to being active earlier. Because even though I did okay, I'll be honest, from the payday on, work wasn't all that much fun. The new company bought us over, didn't really like working for them. And in fact, I went in twice to give my notice and they talked me out of it. And then they let me go when COVID happened. So I guess I got my wish. But for me personally, so again, I want to make sure I'm clear. I never encourage people to leave their job and go do real estate investing. Everybody says, well, once I get enough passive income to live, I'm going to go do that. No, once you got more money than you need to live, you got more money coming in, right? You want to continue that compound interest that I talked about to where it's a substantial nest egg is built up. But on the active side, because I wanted to go active, because I'm very passionate about doing it, so I wanted to be more than just a passive investor. I wanted to be active. I wanted to be creating wealth for people. So I would have started that a little earlier.
Fair enough. No, that's very good. There's quite a few people that I've talked to, and they say that they want to hurry up and quit their job. And I was like, nah, you don't
Yeah.
want to do that yet. You want to keep your job and you invest passively, allow uh, the investment to produce some income, and then, like you said, compound that with your regular job to make that because times like this, there are investments out there that they halted on some cash flow.
Yeah.
So if you depending on the cash flow to survive and they halt the cash flow, you're in trouble.
You're in
So
trouble.
those are very good, wise advice. So thank you for that.
And if I went even back further, okay, so I don't know if we got any really young folks on the group call here, but if I was a young guy starting over, bigger pockets and house hacking, learn about bigger pockets and house hacking, buy a house. I knew a young man who bought a house, slept on the floor in the basement until he was able to build his own bedroom down there, rented out all the bedrooms, was cash flowing positive. Then he bought a duplex, but he only bought one half. Then the other half came up and he bought the other half. And then a fourplex came up and he bought a fourplex and he kept doing it. And he was also able, you have to be careful how you do it, but he was a VA, I had VA loans as well. So there's other ways to do it. And living in the house, it's all different. But if I was starting over again, it's really hard. I'm not renting my bedrooms out right now and all this stuff. It's just but if you think about that, right? Buy a house, get somebody else to pay all of the expenses. Don't go living off of your salary. Go buy the house next door and then take a duplex and make it a fourplex. Take a fourplex, make it an eightplex. And you will set yourself up very quickly for, wealth creation that way, because it's hard, right? Most investments are minimum of $50,000. It's hard for a young person to come up with $50,000. There are ways to do it. Find 5 friends, put 10,000 each, form a limited corporation and invest that way. Again, the biggest lesson is don't wait to buy real estate and wait.
Wise advice right there.
And it's not get rich.
Not get rich fast, right?
Part of it. The wait is an important part of it, right? It's time. It takes time. But once it starts multiplying, just like that math that I did, 1, 2, 4, 8, 1.6, 3.2. Once you get into those big numbers, boy, it really starts to grow.
Well, as we wrap up, I'm going to ask you a question about this this thing you have behind you. But while we're doing that, I want anybody else to drop in the chat if you have any questions. What questions do you have for Trevor? And while you're thinking of those and getting those into the chat box, what in the world is Massive Capital?
So Massive
what in the world's going on there?
So Massive Capital is actually a group of friends of mine. So oddly enough, my very first passive investment after I joined the mentorship program was a guy named Sanjay Agarwal. My first 2 passive investments, he was the asset manager on those particular investments, and we met and connected. Then I connected with some other friends that became part of Massive Capital. And to be honest, I watched them for all of last year. and they bought about $100 million worth of real estate. They started to grow really quickly. A couple of them had already been doing full time, and then Shrar, the main guy, he left his job and started doing it full time. And it was an opportunity for me to be a part of something bigger. So as I mentioned before, I was on 3 deals, but there was 3 different groups of partnerships, a lot of work, a lot of moving pieces. And this allowed me to be part of something bigger. And I was super impressed, every Wednesday night we do a webinar. Tomorrow we're talking about, I'm looking at deals and how to be cautious and how do you pick a sponsor, some of the things I've talked about tonight. And these guys are way smarter than me. It's pretty, I know I'm super smart. It's hard to be, but I'm only being funny. But, it was like, and so I just liked the way that they did business and how they cared for people and how they mentor people and share information. And it just, we started talking in November. I joined right after Christmas and jumped right in. So, someone said, how did I go from LP to GP? And it was a long, hard road. So one of the things I didn't talk about was my first GP deal. 6 months of my life, we lost $350,000, of which 75 was mine. I want to make sure I'm clear. No passive investors lost money. We returned 100% of it. It was our money at risk, but it was a big deal. And I was so excited. It was a $25 million deal. We were doing a loan assumption with third-party pref equity. Well, long story short, after 6 months, 3 portions of hard money down to extend, which the last 75 was my hard money to extend the deal. 24 hours before we were supposed to get approval, we got declined with no hope to save the deal after 6 months of working every day on it. So it was tough. And then, it was really tough. That was a big blow. And then I managed to get on another deal. Well, we didn't raise enough money and we couldn't close the deal. And then I started doing boots on the ground broker tours for a group of people that were looking to get in the Texas market. And they actually called me and said, we got a deal under contract, but we got a problem. We thought everything was done, but it's not done. And we need $3 million in 3 days. Do you have any investors? And I said, well, the first round of people, I gave them money back on my first deal. Half of them put it in my second deal. And half went into, and that's how I got my first GP. And again, it became from networking, putting myself out there, at my own expense. I was driving to Lubbock, Texas and doing broker tours and learning properties. I was putting myself out there, and that ended up giving me that opportunity. And then I'd been trying to buy, I was putting offers in like crazy and not winning, super frustrated. And, and I was working with a local lady who's a property manager, and I kept saying, we need to do a deal together. We need to do it. And she got a deal, but there was no room for me. And it was like, and then one night she texted me and said, I got a deal in San Antonio. Are you interested? And we closed November of last year. It's been going great. I'm active asset manager on that one. And, again, it was all about building relationships. That's how I got on that deal. And to be honest, that's how I got it with Massive Capital, right? I didn't phone up and say, what's in it for me? I said, how can I help? I helped for a while promote their stuff. And then they said, well, would you like to join us? And so I think the most important thing for you to do is to put yourself out there with no expectation other than to be a servant. If you've never read the book Go Giver, read it, read it. It's an amazing book. And it talks all about that.
Yeah, what is that? The Zig Ziglar quote that I'm going to butcher is like, you can get anything in life that you want if you help everybody else get what they want.
That's exactly it. Yeah, it's a great quote.
Yeah. Well, Trevor, I appreciate your time today, dropping all this wisdom and experience. I haven't met very many people who have been involved in as many LP deals and then has switched to GP so recently and done so much. So it's a really, truly, I think, unique perspective from what I can tell. And I really appreciate your attitude. And I think everybody else here would second that notion. So where can people find you if they want to get to know you better?
So I did put my link tree in the chat at the beginning. I can put it again here. And it has all of my contact. I'm harder to connect on Facebook because I'm almost at these 5,000 friends, but I do have a Facebook group. And LinkedIn is super easy, Trevor Thompson. In fact, it was crazy. I went to promote this event and I wasn't friends with Paul, and we'd known each other for a while. Like, how can we not be friends on LinkedIn?
Yeah, isn't that crazy?
But if you click that link, and there's also a link at the bottom, you can book a Zoom call with me. Please look at my YouTube page and subscribe and like. I try to post, again, nothing but educational material. I've got a little video with my airplane analogy on there. I try to have some fun.
Okay. Well, speaking of that, I will, the recording of this will be posted on my YouTube channel for everybody to see. So I appreciate your time and energy tonight. And any last words of wisdom before we say goodnight tonight?
You know, I'm just going to say, don't wait to buy real estate, buy real estate and wait. And, you know, find some way to keep learning. It's so important.
Another thing is that we're just to let our audience know that we always have deals that our audience can participate in. Some deals we can talk about, some deals we can't talk about on the call if we don't have a prior relationship. But just reach out to us if you want to learn or you want to find out, you know, how you can get involved and things like that. And Paul, you don't mind, you know, put your information on the chat so they know where to how to reach out to you. Trevor, of course, already have, and I've posted my information also. So just know that we not only we're doing this to educate and give, but there's always deals that you can reach out to us and inquire about it. Okay.
Excellent. Good night, everybody. I appreciate everybody's time, and go make some offers.
Thanks for having me. It was a pleasure.
Take
Thank
care,
you,
Kevin.
Trevor. You have a good
Yeah.
evening, Trevor.
Bye.